You are working harder than your parents ever did, yet somehow they were buying houses in their mid-20s, while you are 30 and still grinding to pay rent. It feels like the treadmill keeps getting steeper. The news typically blames this on a simple problem of supply and demand. Not enough houses, too many buyers, or foreign investors. While those factors exist, they mask the massive structural engine actually driving housing costs up: easy bank credit. To understand why a starter home feels mathematically impossible to afford, we have to look at the money itself. Specifically, we have to look past the common assumption of where that money actually originates. If you ask 1,000 people who creates the money in their country, 84% will point to the government or the central bank. It is a logical guess. We assume something this powerful has to be controlled by the state. The reality is a massive imbalance. The government only prints that tiny 3% sliver, the physical paper and coins in your wallet. The other 97% of our money is commercial bank money, created digitally by private banks out of thin air. In 2014, a banking and finance professor named Richard Werner conducted a specific field experiment inside a small German bank. He became the first person to scientifically document this creation process in real time. He watched as the bankers approved a loan. They didn't move money from someone else's savings account or touch their vault. They simply typed the loan amount into the customer's account. $10,000 that did not exist a minute prior was suddenly real, spendable cash. Most of us believe banks need our deposits to survive so they can lend them out. But by law, in most Western countries, the legal reserve requirement is exactly zero. A bank does not have to hold any of your savings before issuing a new loan. Even the central banking system confirms this. Shortly after Werner's study, the Bank of England published official papers stating clearly that commercial banks create money by making new loans. The system works exactly the way Werner observed. This process relies on a standard accounting practice called double-entry bookkeeping. Every financial transaction a bank makes must appear on two sides of their ledger simultaneously. For a $10,000 loan, the bank records what they own on the left side. When you sign the paperwork, your legal promise to pay them back in the future becomes a bank asset. On the right side, the bank records what they owe. To balance the ledger, the banker simply types $10,000 into your account. Both sides grow by $10,000, generated entirely by keystrokes. When you eventually pay back that $10,000 in principal, the money doesn't go into a vault. It vanishes. The same keyboard that typed it into existence deletes it from the system forever. The principal was a temporary digital entry, but the interest you paid every month over the life of that loan was very real, and the bank keeps that interest as their permanent profit. Because loans are just matching ledger entries, banks aren't limited by their cash on hand. The only real constraint on money creation is who the bank decides to lend to. Since private banks control the creation of nearly all our money, the logical next question is where they choose to direct it. Ask a bank for a $50,000 loan to start a neighborhood business, and you will face weeks of scrutiny, high interest, and likely a rejection. But ask for $400,000 for a residential mortgage, and the approval process is remarkably smooth. This is a matter of mathematical incentives. Lending to a business is risky. If the startup fails, the bank loses. But mortgages are safe. If you stop paying, the bank simply seizes the physical house to recover their investment. Data from the UK highlights this divide. Over a 14-year period, mortgage lending exploded upward, while lending to small productive businesses remained totally stagnant. Banks are systematically incentivized to pump newly created money toward people buying existing assets, like houses, rather than those building new enterprises. When trillions of new, digitally created dollars are funneled directly into the property market, you have a massive surplus of money chasing a fixed number of homes. This dynamic forces housing prices to surge, entirely independent of actual supply or the quality of the homes. The sheer volume of new credit makes the market more expensive for everyone. In its basic form, money is a digital storage system for the limited time and labor you have already spent in your life. When banks create money from nothing to inflate the cost of housing, they are devaluing the hours you have already worked. They are effectively stealing your time. Creating money out of nothing is merely a tool. The outcome depends entirely on the direction it flows. Lending $1 million for a mortgage creates no new jobs or wealth. It just moves a house from one hand to another. But lending that same million to a small business builds infrastructure and hires workers. Mega banks avoid small business loans because the administrative effort is the same whether the loan is for $50,000 or $50 million. They prioritize the massive payouts of corporate deals. Professor Werner's proposed solution is a network of small, localized banks. We need banking managers who are actually embedded in their communities and understand the businesses they serve. This isn't just theory. In 1978, Chinese leader Deng Xiaoping launched a major banking reform. He decentralized the system by establishing thousands of small, local, village-level banks across the country. This structure forced new capital directly into local production and factories. It fueled 4 decades of sustained growth and moved hundreds of millions of people out of poverty by pointing money at the right things. The rules of the game were changed to favor asset inflation over real productivity. But once we finally recognize that money is a designed system rather than an unchangeable force of nature, we can begin to demand an economy that works for our time.